Despite rising oil prices and despite higher yields, global equity markets continue to climb to record high levels. Stronger than expected earnings, largely driven by AI and energy giants, helped the S&P 500 deliver its strongest earnings growth since 2021, while emerging markets and Asian technology stocks also surged. But beneath the optimism, cracks are emerging. So welcome to Swissquote's Daily Market Talk. It's Tuesday, 12th of May. I'm İpek Özkardeşkaya. I gathered a few red flags regarding the relentless equity rally that I will share in this video. But before I do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So major US and European indices resisted well yesterday to a sharp rise in oil prices after the US and Iran peace hopes fell down a cliff. Regardless, the S&P 500 and Nasdaq printed fresh record high levels. Even the industry-heavy Dow Jones Index eked out a small gain. Again, most gains came from the technology names, with OneX Semiconductor ETF surging another 1.72% to, of course, another record high level, while the European indices were a little bit less enthusiastic than that, as rising yields in Europe as reaction to rising oil prices and rising inflation expectations somehow tamed enthusiasm. This morning, the US crude is consolidating between the $98 to $100 per barrel range, and futures are slightly in the negative. Now, I trained myself to look at the market with different and rosier glasses. Because let's admit that stock prices have risen despite financial crisis, pandemics, wars, energy crisis, and so. Measures like liquidity injections, QE, lower rates, and fiscal spending help. New tools and technologies increase productivity, new businesses pop up, and the world just moves on. But what we see today is that the downside corrections are disappearing, leaving no room for the market to readjust. Today, the market is rallying on good news and on bad news with hope that things will get better tomorrow. And that's leading to a parabolic rise in some sectors. As much as I love technology and stocks involved, a chart like KOSPI Index, for example, raises a few questions indeed. So I collected a few charts and opinions regarding what is causing the market rally to extend despite the deluge of unideal geopolitical headlines and rising energy prices as well, considering that energy is the building block of every sector out there from food to technology. Now, the major one that we are pointing at is the strong earnings, obviously. According to FactSet, among 89% of the S&P 500 companies that already reported results so far, 84% reported a positive EPS surprise and 80% posted a positive revenue surprise. And the earnings expectations were not soft heading into the first quarter earnings. The S&P 500 earnings growth was expected to be around 13% year over year. Now that we're entering the final stretch of this earnings season, the verdict is the S&P 500 companies' earnings growth has been near 27.7%. 27.7. If that 27.7% is confirmed as a final growth rate for this quarter, it would mark the S&P 500's strongest earnings growth since the fourth quarter of 2021, when earnings rose 32%, says FactSet. In other words, the S&P 500's earnings growth came in at roughly twice the level analysts had expected. How come? Well, stronger than expected AI-driven growth, resilient demand, and surging energy profits led companies to massively outperform the expectations. And that's fine. That also explains why the equity rally has narrowed to a handful of technology and energy stocks. In fact, if you strip the technology names out of the equation, the implied earnings growth for the rest of the S&P 500 index was likely in the mid-single digits, roughly around 5 to 7%. And the technology optimism and strong earnings also pushed chip-heavy Asian indices higher as well, with TAIEX and KOSPI standing out. But if you broaden the scope beyond the US and beyond the chip makers, and despite the rising oil prices and the strongish US dollar, the EM stocks also extended gains to record high levels. Why? Because investors rotated away from expensive US equities into cheaper international and EM valuations maybe, and despite the strong US dollar, global liquidity remain abundant because AI-driven capex and commodity revenues likely continued recycling into financial markets, and central banks also helped. Copper, for example, a barometer for global economic health, rose 24% since the end of March. So something doesn't add up. First, the higher energy prices and stronger US dollar are fundamentally harmful to EM markets. And those who are not technology heavy will at some point face the reality of energy scarcity. And it's only EM. If the Middle East war doesn't end quickly, the world, including the G7 that have been relying heavily on their ample oil reserves, will also start facing energy scarcity. If there is no resolution to the Middle East conflict, if the Strait of Hormuz remains closed and energy flows restricted, the world oil inventories will reach the operation stress level by June. And if there is no resolution to the Middle East conflict by September, the world oil inventories are expected to dive to the operational floor level. This is the minimum level that is required to keep pipelines functioning and refineries operating. So that risk is clearly being underpriced, not to say mostly ignored, overshadowed by the strength of technology earnings. But even regarding the earnings, in an ex-post Mike Zaccardi highlights that this year's global equity rally is almost entirely driven by higher EPS estimates. Not the reality, but estimates. And the latter is especially striking for the MSCI EM stocks. And last but not least, Michael Burry, the biggest bear of all time, whose hedge fund has been washed out by the strength of the bullish tide recently, insists that today's technology rally looks like the peak of the dot-com bubble because he highlights that the Nasdaq 100 is priced at 43 times its earnings, above the implied level of 30. He argues Wall Street may be overstating by more than 50% the earnings at our fastest growing, more highly valued companies. The ones that helped the S&P 500 print that 27.7% earnings growth versus just 5 to 7% growth that would have been printed if they were not there. He says the best would be to scale back exposure to surging technology stocks and that the current market environment has reached historically dangerous extremes reminiscent of prior speculative bubbles. So yes, right now there are a lot of talks and opinions out there regarding the impressive market rally and whether this rally could be sustainable in the longer run when the economic fundamentals, the geopolitics, and the data are not necessarily pointing at an ideal future, at least in the very short run. So I'll let you digest these points, have your own opinion, and cite a great comment that came to my episode yesterday. The market can be irrational longer than you can remain solvent. Anyway, today the US inflation report will be in focus, with inflation expected to have risen due to the Iran-led jump in energy prices in the US last month. A higher than expected report could revive the hawkish Federal Reserve expectations, push the yields higher, and weigh on equity valuations. While the softer than expected read will give relief that energy-led inflation is maybe being contained, but in all cases, the US is trying to put several measures together today to ease the price pressures moving forward, and that includes a gas tax holiday proposal, for example, and tariff rate quota suspension on beef. The rising energy prices could easily eat that up, along with the building pressure on Chinese good prices that had so far helped keeping inflation in check in the West. Today, even that brick is about to fall. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.